Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And that would make me Guy Allard. How's everyone doing today?
I don't know. They're not answering us.
I know. We're waiting for the phones to light up.
Today we're going to kind of depart from our normal routine or whatever. We're going to talk about the package we sent out and kind of show you what we, how our mindset is. Remember, everything we do is based on math. I don't like sales pitches and BS. I just like math. My kids don't like math. I do.
That's right. They're not going to be engineers. Is that what you're saying?
No.
Yeah, we get a lot of questions. We talk a lot about the investor kit, and if you'd like a quote, and like to see if you're going to run out of money, and talk about the various options that are available and what you can use and where you can allocate the funds to. We're going to go through the investor kit, the information we send out when it's requested, page by page, so that you can get a feel for what we're doing and why we do it, and hopefully it'll be real clear.
I had a listener call and said, "You hate stocks, you hate bonds. What do you like?" And I was like, "I don't hate stocks. I love stocks." We've been advising people in stock market and managing stock market portfolios for decades.
Absolutely.
I own stocks. I've always owned stocks. I continue to own stocks. Nothing wrong with stocks. Bonds. I like bonds. I'm a municipal bond principal, which is like an expert on municipal bonds. So I love bonds. It's just right now, bonds aren't paying enough for the risk we're taking because the interest rates go up, bonds go down. Well, so it's temporary.
And the logical thing is, if you think about it, we get older, right? We don't get younger. So what do you need to do with your portfolio as we get older? It's just a natural progression. You need to de-risk the portfolio. So as we get older, right, we're not getting younger. We have to move away from the stocks and into safer things. So it's just a natural progression.
Right. And with the stocks, I love the stock market. Like I said, I started out as a stockbroker. That's a bad word now. But everybody, they didn't have financial advisors back then. You were a stockbroker, a commodity broker, whatever, right? Real estate broker, that's what you did. So I like stocks. It's just, I tell people you have to start changing your allocation or lowering your allocation because you've gotten older and we're in a 10-year bull market. It went down a little bit at the end of last year, right? But it's still a 10-year bull market. And anytime you have older the bull market gets, the more you have to be leery and start lowering your allocation. If you'd have done that every time throughout history, all the way 2000, before it went down, you'd have been much better off. Same thing 2007, before it went down 2008, much better off. But what happens is, if you got one asset class outperforming the other, you might have started with a 50-50 allocation. But since your bond allocation only made so much, but your stock allocation made much more, you might have an 80% allocation 5 years later. And so, but if you'll keep rebalancing, but it's almost feels counterintuitive to do that. So, okay, you want me to take something out of the one that's done good, put it into something that's done not as good, and start doing more of that every year. Is that what you're telling me?
It's all about the allocation. If you think about it, when we started out, and stockbrokers we were in our 20s, our risk tolerance was different. Our knowledge level, the wisdom, if you will, was different. We were more risky, and we were willing to do that. And that's one of the reasons why you're looking and interviewing for advisors. The young ones can have Harvard degrees. They can have Ivy League degrees. They can be sharp. But, we hire people all the time to be advisor trainees and all of that. And the ones that come out with the degrees and all that stuff, they've got to gather the wisdom. They've got to get the experience. So it's real. Again, nothing wrong with younger folks out there doing this, but you really want someone that's seasoned before you place your money.
Well, I was talking to my son, who's 16, just recently driving. And I said, think about it. I've been driving for, 40 years. I go, so if you've been driving for 40 years, do you think you can drive better today than yesterday? 4 days? Of course, right? So 40 years added up, it's just experience. Nothing takes the place of experience. Don't get me wrong, you can have theoretical knowledge to choke a horse, but if you don't have any practical knowledge, in other words, I want somebody that's been there, done that. If it's a good market or bad market or somewhere in between, They've done it, they've been in it, and they know how to react in each one.
I want to go back to your driving thing because I know for sure you said your wife isn't getting any better.
I don't think it's going to happen.
Driving wise, I mean.
Better than my mother-in-law.
Oh, really?
Hit the garage on one side, ran over the power washer on the other side.
Are you serious?
Yeah. So getting 10 feet out of the garage, hit two things.
So the lesson we draw from that is even if a guy is older doesn't mean that he's got the knowledge perhaps for your portfolio. So you need to delve a little deeper.
That's right. But as a reminder, Guy and I have been doing this stuff since the 80s. Okay, neither one of us have ever had a client complaint. That's pretty good in the stock business. And we do that because we're honest right up front. We give you the numbers, how the numbers work out, not some sales pitch. I think this is going to make you 25% a year, blah, blah, blah. Oh my gosh, this will always make 10 because the stock market always makes 10. When they're completely ignoring this whole century, 19 years, the market's made less than half of that. You've got to you have to adjust your numbers as conditions dictate.
And the big buzzword now, and it changes every so many years, right? The big word right nowadays is fiduciary. And we are fiduciaries, which means we're responsible. You would think it's natural that everyone would be, but your concerns are the most important thing. And when we sit down and interview people and we go through and we take a look and we see what they need to do and let their situation drive the conversation and then present options to them. So one of the nice things about today, and we thought we'd go through what we send out and kind of lay a foundation for you. And if you would like us to send you an information pack, find out a little information, please feel free to call. It's 972-715-2424. I haven't used that in a while. I had to think about it, get it real slow and make sure we got it.
972-715-2424. I might even throw a picture of Guy in there.
Oh, well, that would be a special.
For special packages.
They say I've got a face for radio. You know the old joke. And a voice for print. Isn't that the joke? Which one of these pages you want to start off with?
Remember, to me, everything's number-based. Just a reminder, I've been doing this over 30 years. I was a nuclear chemist on the USS Enterprise before I got decommissioned.
Whatever.
And so it's just numbers to me. I took all my college math by the 10th grade. I love math. Now, English was a different story. They go, what's the theme and the thesis? I'm like, isn't it the same thing? I don't know. I have no idea. I'll give you a formula for some advanced algebra, right? And that's easy. All right, what are your odds that your money will last?
This is one of the forms that's in there is the odds.
Yeah, what is your odds your money will last?
Based on what you withdraw.
That's right. Because I hear people all the time saying, I'm going to take out 6%. And you've heard the 4% rule forever. It's been around since 92.
Yep.
5%. And what people do is they'll take the stock market. Oh, it's average 10% a year. I'm just going to take out 6, and I'll be making money every year.
My money will grow.
They ignore the sequence of returns risk. In other words, market went down 50%, you got $1 million, you got 500,000. If you took out that 5%, you got 450, right? I don't care what it makes going forward. You're probably going to go broke.
Yeah.
If it's at the beginning of retirement especially. That's the sequence of return. So what they did was they put different stock and bond mixes together and said, all right, if you take out 4% and you're a 50-50 portfolio or 40-60, whatever, what are the odds I'm not going to run out? Well, 4% says if you're a 60-40 portfolio, 60% stocks, 40% bonds, all right, you got an 87% chance of not running out of money. 87%. Where it starts getting tricky, that same 60-40, if you take 5% out, comes to a 63% chance of not running out of money. If you take 6% out, it's a 38% chance of not running out of money. Taking out 7%, in other words, you got $1 million, take out 70 a year. 19% chance of success. 19.
That's terrible.
So I see people all the time saying, no, you don't understand. I do this stock portfolio. This is my averages over time. I don't care if you start with a basis that says 20% of the time you're going to succeed. I don't care what kind of genius trader you think you are. It does not matter. You cannot fight those odds. It will get you.
What you'll find out is the greater your withdrawal rate is. And this chart that you'll get and that we send out gives you 7%, 6%, 5%, and 4% withdrawal rate. The greater withdrawal rate that you require is kind of a catch-22. The greater that number is, the more you have to have in stocks. And it's a catch-22 because it doesn't work. And an example on this chart, if you have 20% in stocks and 80% in bonds, right, because you're 80 years old and you need to have 80% of the money safe, you've got a 1% chance that you're not going to run out of money. Why? Because you're drawing 7%. You can't get bonds that pay that.
Right.
So the higher your withdrawal rate is, it forces you more into the market. So again, it comes down to being a good saver.
You can't argue with numbers. The problem is what these numbers were ran a couple of years ago, and they're taking into account really long-term stock market returns. When the last 20 years, the stock market's returned half of what it has normally. Is that the new normal? Who knows?
Right.
But it looks like it is now, and you have to account for that. So I would even use lower withdrawal rates if you want to be sure. Well, that's we got a break coming up, folks. Stay with us. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Or go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the Common Sense Investing Show. We've got Victor McClure and Guy Allard. That's me. Today we're taking a little time and we're going through our summary package, kind of show what we send out to folks when they call and ask for the investor pack. The first segment, if you missed it, we talked about one of the pages that goes in the package. It's called What Are Your Odds Your Money Will Last? Basically shows different withdrawal rates and different mixes of stock and bond portfolios and what percentage chance you have of not running out of money. Very good information to have.
What we'll talk about now. Remember, I like numbers. Numbers are good. But we're just trying to give you ideas on, okay, how much you can take your savings, right?
Mm-hmm.
And you know you're going to retire at a certain date or already retired. So how much can you safely withdraw and not go broke? That's really what these numbers are talking about. And so there's another thing. Let's say I've got 5 years or 10 years to retirement. And I'm trying to figure out, all right, what should I use as an income number? Because the reason is I got to account for growth for that 5 years, right?
And what number do you use for growth?
Right.
Right.
And so what we've done is we've got another spreadsheet in there that shows you that. All right. Let's say you got 5 years to retirement and you saved $1 million. It works no matter what number you put in there. I can actually send you the Excel spreadsheet if you want to mess with it. But,
absolutely.
All right. But you can put a number in there and say, all right, what if I'm a 50-50 portfolio? Another 50% equities, 50% fixed income, or a 70-30 or a 30-50, whatever. But it says I use 50-50 just because it's an easy one, and more people are close to that allocation than anything else. But it says if I was going to take out 4% a year. Now, remember we talked about the withdrawal rates? The problem is they redid all of that 4% rule at the end of 2013.
Down to 2.8 or something
2.8.
silly. Yeah.
Even the people that hate annuities, like Kid Fisher, all that stuff, they say, well, no, if you take out this much, you're going to probably run out.
Yep.
It's all in their form there. But you got to look at that and say, okay, if it's 4% and I'm a 50-50 stock and bond portfolio, what you can use is don't use 100-year averages for stocks because it's a new world now. The stocks haven't made 10% for 20 years. We're in the era of 4.5% stocks.
Look at Sears and Roebuck. They'd never go out of business.
4.5% for stocks. Right now, bonds, 10-year bonds paying about 3. Cash is paying about 1 if you're lucky. Right? Sometimes you get some of these money markets paying a little bit. Sometimes 1.8, 0.5, whatever. Just 1% is a good number. But if you did that and you're going to retire in 5 years, your million should be worth, if you're a 50-50 portfolio,
right, using
today's numbers, about $1.2 million. So 4% of that would be $48,000 a year. Okay? Same thing, same person going to do it for 10 years of retirement. He's not going to retire for 10 years, or she's not going to retire for 10 years. The $1 million turns into 1,445, which is $57,000 in
income
you can take out,
yep,
and potentially not run out of money. Okay? I've also ran it for 2.8% on another one. I don't want to go into that one just because it's obviously a lower income number.
But it's included in the package.
But then when you see all these different people touting annuities or touting bond funds or whatever, what you got to do is compare them against these income numbers. Because you can keep a portfolio at 50-50 if you're going to take out these amount of numbers, right? and it should last 20, 30 years. So if somebody's giving you an annuity quote or anything else, it needs to pay more than these numbers. So if you're going to be 5 years, like right now, we looked up some earlier, a lot of the fixed annuities, the low fee to no fee stuff. We don't ever do high fee anything. But if it's a low fee to no fee stuff, 5 years of deferral gets you 70, 80,000 a year.
That's right.
All right, instead of 48. And if you're going to defer 10 years, you get like 90 to 110,000 a year on $1 million. Now, put that backwards. I put in $1 million, I'm going to get 100 to 110,000 income per year. That's a lot of income
like
per
10
dollar.
11%.
That's right. And so the real reason why annuities are so popular the last 10, 12 years, you see here, more advertised more than you ever had and everything else, is nothing to do with fees and commissions. What they'll try to do is annuity salesperson usually gets a higher upfront. Nothing makes more than a managed account. Ken Fisher charges 1.5% a year on an increasing asset.
That's right.
It's easily the highest fees you'll ever pay.
And the most
no, we do it too. I mean, we're managed account guys.
Absolutely. But the most deceiving line is, we do better when you do better. Well, the reason they do better is because you've got more money in your account. Because if you're losing money, they're gonna be losing commission too.
And all investment advisors, including ourselves, do that.
Right.
But I'm just trying to give you the overall. So think about it. You got to, if you're going to get between 5 and 10 years, between 48 and 57,000 a year, the real reason they're popular is why when you go on 80,000 to 110,000 a year in income, same exact scenario. And by the way, the 48 to 57 gives you about an 80-90% chance of not running out. The 70 to 110,000 a year gives you a 100% chance of not running out. And so that's the real reason they're popular. Is a lot of people, they've saved all their lives. They either need more income than 40 or 50 grand a year on this million, or they prefer more income.
And this page is a little bit more elaborate. There's 2 pages Victor talked about. One, we're talking about drawing 4% a year. A second one drawing 2.8%, which is the recommended amount. I'm trying to go fast because we're running out of time. It gives you a 30% stock, 50% bond, 20% cash column. It gives you the 50-50 stocks and bonds that Victor talked about, and the 70 stock, 20 bonds, 10%. So it gives you several scenarios.
Now, I have a lot of engineer clients because we go over numbers like this. I apologize for everybody else that's going to sleep that doesn't like numbers. It's just, that's what our mindset is. You want an advisor that bases everything on math, not what commission or fee they earn. How does the math work in your particular situation? That's exactly what we do. Call us at 972-715-2424. We'll send you out an investing kit, or you can set up an appointment, whatever you'd like. Again, 972-715-2424. We'll be right back after the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome to I'm experienced, Guy is old. That's just the way it is. So.
Now there you go. Hey,
I got to mention it once a show. You know that.
Yeah, that's right. We won't talk about looks. Hey, just real quick. I mean, one of the pages in there. It's an easy page. And by the way, if you're just tuning in, we're talking about our investment kit and the information and the foundation of what we do, and whether you'll run out of money and what your allocations need to be, because allocations are so crucial, what your withdrawal rate should be, and some of the charts and some of the wonderful numbers that we put in the package. One of the pages in there is a kind of a generic example of what different investments are available, and I was going to walk you through it briefly. The first one is stocks that you can grow, and obviously the best potential depending on how you do it, also the most risk. The second one on the deal is mutual funds, same sort of thing. It's a little bit more diversified than single stocks.
Why mutual funds are less risky? Because there's more stocks.
It's more diversified.
So it's a little bit less risky.
What we do here at McClure Capital, we try to take, at least with our 30 or 60 years combined experience, is the best of both worlds. We've got a wonderful platform with Fidelity, and we do manage money. Our managers, some of their requirements are $50 million plus $100 million before they'll take an investor, but due to kind of a co-op arrangement, if you will, we can put clients with them with as little as a couple $100,000. Our experience and our work experience, we've chosen, how's that for English? better in math, folks. Exchange-traded funds. And the reason that we use those is they're more responsive. With mutual funds, if you call an order in the day and you want to get out of it, they settle at the end of the day. An exchange-traded fund, you can get out. You call and it takes a few minutes and your order's done and you're out of the stock. And they've become so popular, you can do almost anything you want with those. Second on the chart that still gives you market access is variable annuities. Now, there's some that work for some people. Maybe you want to elaborate. We're not real
There's
big.
only a couple low-cost. Vanguard's one of them, TIAA CREF. And there's one from Jackson that's a really low fee, but what happens is advisors add a fee to it.
Right.
So it's still lower than your typical retail ones.
Right.
The retail variable annuities have the highest fees I've ever seen, 3 to 5% a year when you add the riders in. Now, I'm telling you right now, we told you the market's made 4.5% the last 19 years.
Right.
If I'm going to take the first 4 or 5% in fees, there's not left much left, right?
And even if you get one that's 3.5 only, that's
Yeah,
a lot of money.
You let me one.
That's 35,000 on every
It's
million. That's
terrible.
Crazy high.
Now, does that mean all variable annuities are bad? No, I've mentioned a couple of them. They're okay.
Yes.
Because they do all annuities give you tax deferred, judgment proof, avoid probate, a lot of different benefits of annuities, but you can't, they're not worth 5% a year.
No.
But if you go to the fixed or fixed index, you're getting for 0 to 1%. Now you can determine if those are right for you because the fees are much lower.
And there's a lot of misinformation out there. You have to be careful. A lot of times they'll try to cover their inadequacies with a rider. Well, you've got a guaranteed minimum. Well, the guaranteed minimum, what you don't know to ask is you don't walk away with this guaranteed money or this death benefit
if you
or
die,
life benefit.
in other words, you go broke, but your heirs, they'll be okay.
Right. Or if it's a living benefit, you don't get a lump sum. You've got to take it over 10 years. And during that 10 years, it doesn't earn anything. So there's issues with those. The next and the one you're probably the most familiar with are bonds. Bonds are a wonderful tool. If you've got a ton of money and you're in the highest income bracket, then tax-free bonds are great. Most people...
They're just not paying enough now, but they're still a really good investment.
That's right. Cash, we always talk about it. One of the buckets we like to talk about. You have to have it, but it's expensive because you don't earn much on it. CDs used to be a good thing. There's probably a better way, but that's certainly an option.
Banks are part of my axis of evil. They don't pay enough. They want to charge you 25% on a credit card, give you one.
The fact that you can have people steal your credit cards 4 times a year and they don't charge you and they don't pursue the perpetrator tells you they're making a lot of money, doesn't it? And now we get into fixed annuities, kind of like a CD, like a multi-year guarantee annuity.
These
Pays
are
a little bit
less
more.
less risk.
Right. And then the least, we've got the fixed equity index. And I don't know if we have time to squeeze it in now, but in the report, we've got a report from Roger Ibbotson, and Schiller from the Schiller PE ratio that explains right now that fixed annuities are the replacement for the foreseeable future for bonds. Now, a lot of the guys you hear on the radio talk about, I predicted this crash and I predicted this bull market, which I think is baloney, but Victor and I have been the vanguards. We've been doing these since 95. And Victor actually gets the credit for bringing them to the firm at the time when we did that before you purchased it.
Yeah, it's one of those things weird. I'm a math guy. High fees never work out mathematically. They only work out with some sales pitch that forgets the high fees, don't talk about them. But low fees, no risk. I can still get market up years, no down years, or guaranteed 4% for 5 years is better than a 2% CD, that kind of stuff. Hey, that's just mathematically accurate. Today we're talking about what's in our package we'll send you. If you'd like one, call us at 972-715-2424 or go to our website, ilovemyretirement.com. Got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. All right, another thing that's in there, we update this every year. We're going to show you what the actual stock market has made the last 10, 15, 20 years or whatever. We don't use long-term averages because things change. I don't care what happened in 1927. It has nothing to do with 2019. And so we're going to take just this century. Remember the market, if you reinvested dividends, which doesn't always happen, you have to have that automatically going, right? If you reinvested dividends, stock market's made 4.46% a year since 2000.
If you paid no fees. Good
And
luck.
People don't. It's hard to realize. They're like, there's no way. I've over doubled my money. Well, if you put in $1 million in 2000, it's worth 2.3 now. So you made 2.3 times your money, right?
1.2. Yeah.
There, but it's only 4.46%. If you just run the numbers if you want to, and it'll come out exact. And so what we did for that is we also showed on the side of this page that's in our investor kit the 4% rule. The 4% rule says I can start with 4% and increase the amount for inflation every year. And so we did that and used inflation rate of 3% or so. It's always been between 2 and 3. And to see what would happen. Because that 4% rule gave me a 90% chance of not running out of money over a 30-year retirement.
Got it.
Well, we're 19 years into this century, right? On your $1 million, you're down to 200,000. And that's after 10 up years in a row. And so the problem with that is it doesn't work anymore. The rules we've tried to set ourselves up with, rules brokers have tried to put out there. I mean, brokers from every single firm out there said, okay, the 4% rule, you can take out the idiots, will put you 6-7%. And we've already talked about earlier in the show how that you got a 19% chance of success. But the 4% rule, if you'd have done it this century, started in 2000, you got 200 grand left on your $1 million. All it takes is one down year, it's over, because you're adding inflation to that initial 40,000 a year on $1 million. It's up to 70,000 almost in income now. So if the market drops 50%, you're down to 100, and you got to take your 70 out. So the money's gone almost in less than 20 years.
And one of the weak links in this chain and the problems with that philosophy, be it a younger or a seasoned fellow that you're talking to, is the market has averaged, the S&P 500, it's diversified, again, call it 4.5% a year, well rounded up, for the last 18 years with dividends, without fees. And the number used to be, and give me 5% leeway either way, about 90% of all money managers, the sharpest minds on the planet, don't get the same return as the S&P 500. But these people are going to sit you down because they know you want a 6% withdrawal, and they're going to show you that they can beat the S&P and be in that top 5% in the world and get you 7% or 8% consistent return after fees. How likely is that?
It's not likely when the market's not moving doing what it does now. It used to make 10%.
Dividends were higher.
Dividends were 4 or 5%.
That's right.
And we're forever. Dividends are 1 or 2% now. And so even if you got good market again, you're talking 7 or 8. That's just the reality of where we're at now. You have to live in today's world. Don't look back. Now, some people do it because they're justifying they didn't save enough money, which happens to all of us. Trust me, I got 4 kids.
Makes you want to chase the larger returns, doesn't it?
One of them only went to college for 9.5 years.
I know. But he's a professor now.
That's right. And
a keynote speaker.
If anybody out there like me, do you know how much these private graduate schools cost? Holy moly. And so that's so I get it. Life happens. But you can't fit a square peg in a round hole. Okay, I only saved $1 million, but I really need 70,000 a year out of this. Okay, but I'm going to stay with this. I
can get that for you because I can average 8%, even though the S&P's only done 4.5.
Advisors will tell you what you want to hear because it's easier sale. Tell him what he wants to hear. We'll get signed up. Even if he finds out that it was BS, we'll have 2 years worth of fees on him. That's what these people do. Instead of just saying, hey, if you need 70,000 a year, you need to look at another investment, something that will guarantee you 70,000 a year or 80,000, whatever it is. And there's only a couple things in the world that'll do that right now.
And you'll need some time to let it defer and grow.
That's right. An annuity would do it. Stay with the low cost stuff. Stay away from anything high cost. It'll never be good. You pay high cost. What they'll do, I've got a person that says, you don't understand, Victor. They've got a special one, and they're with a bigger firm than you. I go, okay. What's the numbers? Well, they're going to pay me $62,000 on that $1 million. I said, oh, that's pretty good. There's 200 annuities that'll pay you more than that. Did they talk about that too?
No.
200 of them. We run every number against all spectrums. Everybody this firm has, we run in that one.
Right.
Everyone this firm has. So if you need this direction, in other words, I can't live on 40 grand a year in $1 million. I need extra. Or otherwise, I'm going to drastically change my lifestyle. Well, let's shop every one of them, not the 2 that they offer.
That's right.
Some of the biggest firms in the United States offer 2 or 3. I've never seen a firm offer 4. We offer 133 in just one type.
Yep.
So that's the difference. You need somebody objective that's going to get you the most income if you need it. There's nothing, but I love these. Like I said, I'm a numbers guy, and I really apologize. I know today's show is probably going to be, they're going to turn off the radio and kill themselves because we're talking numbers so much. But we're talking about what's in the package and what makes our brain work. What our basis of our recommendations are.
And once you get it, it'll make more sense. Now, we've talked a lot about income because that's what these pages that you'll see in the package are about. But also, you can use fixed annuities for growth. You've seen the commercials. Market's done 4.5%. We've got some that are guaranteed the principal will not go down, that average between 4 to 7% over any 10-year rolling. Think about that. You lower or you reduce or eliminate your fees, and you eliminate all your risk, and you get somewhere between 4 and 6%.
There's a new one from one of the largest firms
There you go.
in America, largest, oldest firms in America, 6 to 8% return.
There you go.
Then also you still have the
being
ones
conservative.
ones that are guaranteed like 7.5 for income. All those things exist. Just call us and we'll give you a quote. 972-715-2424. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Today we're doing a boring show on your
All about we're going through
numbers.
charts and numbers.
This will be the only one we run the year, but I just wanted to show you how we think. You know, we're going to think numbers. You want a financial advisor who thinks numbers, not commissions, not what's the hot investment. You want conservative numbers to make sure that I'm not going to go broke. I'm not having to eat cat food when I'm 80. And that's what we do. But we put a lot of work and a lot of effort and a lot of, manpower, hours, everything to ensure that you don't run out of money. It's not some boilerplate template that everybody does. Puts them in there and, hey, hope it works.
Yeah, and what you're going to find in this package, which is what we've been going through for a long time. We talked about a page that talks about actual returns on the S&P in the last segment over average. We've talked about fixed income comparisons from all the things that are out there. Indexed annuities, MYGAs, multi-year guarantee annuities, CDs, muni bonds, corporate bonds, government bonds. We talked about what the odds are that your money will last with different mixes in your portfolio. We talked about how much income you can withdraw from different mixes in your portfolio. So all these things are available for you in the package, and we've got a wonderful 20-page report. Victor, you getting ready to
Yeah, the last thing we're going to do is use
go into that?
It's a 20-page report by Roger Ibbotson.
And don't worry, we're not going to go through all 20 pages of graphs and numbers with you. We want to keep you around.
This is one of the most interesting reports I've seen. Roger Ibbotson is the founder of the Ibbotson charts, also a Yale professor. Now, what they did was, if you used to walk in every stock brokerage firm in the world,
That's right.
there was a giant chart. I had one in my office in the 80s, all the way through everybody.
We all did. $1.
That's right. $1 in bonds is worth $40 since 1927.
That's right.
$1 in treasuries is worth blah, blah, blah. CDs is worth $20. $1 in stocks is worth $10,000 per dollar.
That's right.
So it shows you, stocks are the best thing in the world long term.
Different time, wasn't it?
And they still believe long term. That's why I'm talking about like a 30-year-old. There's nothing wrong with stocks, right? As you get old, you just need to reduce that. It just makes sense.
Problem with being young is you got kids and expenses, and you don't have the real money to put in the market.
But so this is a very pro stock and bond person. Okay, him and Robert Shiller. Now Robert Shiller won the Nobel Prize in economics for the Shiller PE ratio.
Also a Yale professor.
Also a Yale professor. These are very smart stock people, and what they've understood is, and they wrote it a year ago. And they said, okay, interest rates are going up. Bonds are way down. Remember, 10-year bonds are like 1.8%. And they said, well, if the Fed raises rates and interest rates even creep up, we're going to lose money on bonds. But we need to de-risk a portfolio as we get older.
That's right.
So what do we do with these funds? If they're going to go in bonds, I'm de-risking and I'm taking more risk.
Is there a bond alternative?
Right. And so what they did was they said there's an evolution in index annuities. They're different than they were 20 years ago. What they do now, they have some geared towards income, some geared towards growth. They said if you use one of these uncapped ones, remember you get up years of index, no down years. I got one that pays 120% of a balanced index, no down years. If it ever goes down, you can't take a loss. Only gets the up years. They said if you take that and plug it in for a bond, here's what happens. And they did different scenarios. What if interest rates are going down? Okay, how would that compare
How would that
if you
affect
took out the bonds or took out a piece of the bonds and put it in an index annuity instead?
Which is not likely now.
That's right. And now I'm looking at I was looking at these numbers because I've read this report a year ago, and it says if the interest rates are going to go up 3%, well, that's exactly what they're doing. They've gone up 2.
Right.
Remember the Fed's fund rate was like 2.5 now, and it was around 1/2 or 1/4 to 1/2. So they've raised it about 2, but they're still going to raise it another 1. And so I'm looking back at these numbers going, okay, if they raise it 3, what happens? Well, the average bond portfolio loses about 5%. That don't seem too bad, right?
No.
Yeah, but you're hedging your money. What are you going to lose on it, right? And equities, they're going to make what they make, right? They're going to lose 10%, go up. Now, remember, we're in the 10th year of a bull market. It did go down a little bit last year, but it still hasn't really gone into – it's been bouncing back and forth between correction territory.
Volatile.
Very volatile. But they said, all right, if I've got a 60-40 stocks and bonds, right? If the market makes 10, you're going to get 4.1 if the stock and bond portfolio. If it makes 20% in the stock market with a 60-40, you're going to make 10.1. And all they did is switch out to an index annuity. And the 4.1 turned into 7.5. And the 8.3 turned into 15%. You're getting between a 50 and 100% extra return, and you eliminated the market risk on that piece instead of adding the market risk on that piece.
And don't worry about the individual numbers. The point is, this is a 20-page comprehensive report by a very sharp individual, and the capsulized version is it shows you how your money will perform with different interest rates up or down, with different stock market reactions up or down, with different allocations between stocks and bonds or stocks and fixed annuities. It's black and white. It's numbers like we've always talked about. You can see for yourself exactly how your money will perform with different variations.
Now, how did it take? Remember, I've been doing this a long time. I'm a pro stock guy. We started out as Series 7 stock brokers.
We did that for years before we even thought about an annuity.
Right. But at the beginning, it was a fight. In other words, annuities are terrible. Well, they're referring to variables most of the time.
Thinking about variable annuities, that's right.
If a guy was attacking index annuities, oh, no, that can't be right. They're capped too much, blah, blah, blah. The conclusion of this report is the evolution of these things. Now you've got the biggest academics and economics that are saying, hey,
big words.
This is a real alternative you need to look at. It doesn't matter what you thought about them 5 years ago, 10 years ago, whatever. It's definitely need to look now. And we include this all in that package. Don't hesitate to call us. We'd be more than happy to mail one out to you. 972-715-2424. Again, 972-715-2424. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.